We all know that the PDT rule, the one that said that you needed $25,000 to day trade, is gone. But if you're a new trader and you've seen in the headlines that the new minimum is $2,000, that's not totally correct. I'm going to walk you through exactly what the old rule required, what changed, what didn't, and what you need to check with your own broker. Let's get into it. So before we get into what's changed, let's be clear about what the old rule actually was. FINRA, which is the Financial Industry Regulatory Authority, it's the organization that regulates U.S. brokers, and they operate under SEC oversight. SEC stands for the Security and Exchanges Commission. If you were trading, they said that if you were trading in a margin account and executed 4 or more day trades within 5 business days, you got flagged as something called a pattern day trader, which meant that you needed at least $25,000 in equity to keep day trading. Below $25,000, you were capped at 3 day trades per rolling 5-day window in that margin account. Now, a lot of day traders got around this, including myself, without ever hitting $25,000 in their account, okay? And they did this because the rule only ever applied to margin accounts. Cash accounts were never subject to this rule at all, okay? And the trade-off was settlement time. In a cash account, you can only trade with money that's already settled. So once you kind of used up your dollars, you had to wait until the next day to get those dollars back to use, okay? But in a margin account, you could just trade up to your margin limit, okay? So this is the wall that existed pretty much since 2001. On April 14th, 2026, the SEC approved an amendment to that rule. This is SEC release number 34-105226, okay? Following that, FINRA published the details in a regulatory notice, okay? This is regulatory notice 2610. They released this on April 20th, all right? And the change was scheduled to take effect on June 4th, 2026, okay? I will put links in the description below for both of these documents. Here's the important part. This isn't just a small tweak to the $25,000 number. The entire pattern day trader rule is eliminated. The day trade counting, the 4 and 5 days test is gone. The $25,000 requirement is eliminated. The whole classification of pattern day trader as a category doesn't exist anymore. Okay, this right here is the new FINRA Rule 4210, and I will put a link in the description below if you are interested in reading it in its entirety. A little light reading on the weekend. Now, here's where a lot of people, including me at first, get this wrong. You've probably seen people say the new PDT rule is $2,000. That makes it sound like FINRA swapped $25,000 for $2,000 as the new day trading threshold. That's not exactly what happened. Okay, $2,000 is the pre-existing starting minimum standard equity required to open and use any margin account at all under Regulation T. That's been the rule for margin accounts generally for decades, completely separate from day trading. It's not a new number FINRA created for day traders. If you have $2,000 in a margin account, you meet the baseline to have that account. That was already true before this change and has nothing specifically to do with day trading limits, okay? But what did replace day trade counting? So if there's no more counting your trades and no more fixed dollar wall, what's actually watching your account now? So FINRA's replacement is called an intraday margin framework. Instead of counting how many day trades you make, Your broker now monitors like your actual market exposure in real time throughout the trading day. Okay, so in plainer terms, if the positions you're holding exceed what your account equity can support, you get what's called an intraday margin call. If that happens repeatedly, you can still face restriction up to 90 days, which is similar in spirit to the old PDT restriction, just triggered by a different mechanism. The oversight hasn't disappeared. It's just based on your actual risk exposure instead of a trade account trigger. So a few practical things before you assume this applies to you. First, this rollout has happened broker by broker. I think most firms have rolled it out by now, but they technically have until October 20th, 2027 to fully implement the new system. So depending on who you trade with, you may already be on the new framework or you may still be under the old style restrictions. So check with your specific broker before you change how you're trading. And this video is really geared towards new traders, so we're always going to err on the side of caution. Second, this applies to equities and equity options traded through FINRA member firms. If you're trading like futures or Forex or crypto, this change doesn't affect you. Okay, those markets were never under the PDT rule to begin with. And third, with the $25,000 wall gone, the main reason a lot of traders were using cash accounts as a workaround largely disappeared. Okay, I actually had a cash account. Now my account is a margin account. If you were running a cash account specifically to dodge PDT, it's worth checking whether a margin account now makes more sense for you. Like for me, it made so much more sense. Honestly, I don't really trade over my cash limit much anyway, but I might in the future. And it allows me to not have to deal with waiting for my funds to settle until the next day, which is pretty good. Okay, so here's a little summary to wrap things up. The $25,000 wall is down, and the 4 trades in 5 days count doesn't exist anymore. Woohoo! But that doesn't mean unrestricted, unlimited free trading, okay? It means a different kind of oversight based on your real-time exposure instead of a static number. So before you change your trading based on this or start trading, confirm with your own broker where they are in the rollout. I use Charles Schwab because they are a commission-free broker, and they rolled out the new PDT rule pretty much right away. It was the Monday following June 4th. I think that was like the 7th or something like that. And so I converted my cash account to a margin account, which allowed me to keep a lot less funds in my account. And because the funds, I can use the funds immediately. I don't have to wait for them to settle until the next day, which is pretty awesome. All right, if you liked this video, please give it a like below, and I will see you in the next one. Trade smart.